Hi, welcome to Outlier Live. So today I just want to go over how markets are doing and where markets are moving and how some of these things like Fed's interest rate are impacting the market. So let's get started. So I opened Goldman Sachs website. I was going over a few reports from Goldman Sachs, BlackRock, and I was trying to understand what their thought process is, whether they are looking if Fed is going to increase rates or not. So this is what I'm reading here. This is one of their key reports. The Fed is likely finished hiking rates as the US avoids recession. Okay, so this is by the way great. I talked about that. We may see another rate increase this year, but it really depends on how things look, right? Your unemployment rate, your how US GDP is doing, your inflation number, so on and so forth. So there are certain things that we have to keep an eye on it. But when I read news like, okay, uh, like for example, jobless claims has gone down. There is no sign of rising unemployment. I mean, you read this news, right? It's like, oh, there are no signs of rising unemployment, means like literally everybody, all the investors, everybody want the unemployment to go up, right? They want of course, they want some of these GDP numbers to come down. Why? Because until that happens, Fed may stay hawkish on the rates, and until Fed do something about the rates, they show an indication that okay, they are going to start taper off these rates, the stock market is probably going to suffer. Now when I say suffer, I'm not saying it's going to keep on going down. What you are going to see are just like small short cycles. Few weeks in, what does that mean? Few weeks in, you may see, stock market going up, everything is looking good, you are optimistic, and then you gather your energy, you try to get back in, right? And then you get caught in that bullish trap, right? And markets start going down again, and then you sell again, right, at the bottom. So you are going to see these smaller cycle until the Fed show a clear indication of tapering the rates down. So I don't know when that happen. Right now, I'll just keep an eye on it and prepare myself for this long, time, probably 6 months, probably a year. I don't know how long of these short cycles, of these small cycles. So who can benefit from it? If you're an active trader or active investor who keeps an eye on how things are doing and who stays on top of the things, right? Then definitely you can benefit from it. I mean, this is like trader's paradise right now, what's happening in the market. But you have to be very careful because not everybody will make money. A lot of them will lose money. Now let's look into, let's try to understand what I was talking about. Why I will see these short cycles in coming months. From 2009, right? After the GFC event, after 2009, what you saw, the rates were almost negligible. I mean, they were like almost closer to 0%, right? They were very low, and stock market saw a consistent growth. You see this I just pulled S&P 500 here. It, like, apart from smaller pullbacks, and by the way, pullbacks have happen every year. Like, apart from smaller pullbacks, it was just on the way up. That was like, okay, whatever I touch, I make money around that time. So it was no brainer. And then you saw some pullbacks back in 2018, and then there was a major pullback around COVID drawdown. So this time, right, what happened? They slashed the rates again. Okay. And then you saw the stock market went up, but Then they suddenly realized they printed too much money, right? And they started increasing the rates back in 2022. And you see that stock market is in bit of a correction from that time. And I personally think that unless they start tapering down the rates, you may see the smaller cycle. You can benefit from them, of course, if you have right data in front of you. But if you're like a passive investor, then you just need to be, just keep that brave face on and just hold off, and just in the longer run it may recover depending on what asset you are in, right? Because right now, if the interest rate stays here, there are going to be a lot of zombie companies that are going to go out of business. So it really really depends on what asset, what stocks, what ETFs you are in, to benefit from this time. So let's look at what BlackRock is thinking. So they are also uh, thinking about staying cautious in this Q4, which is coming up, right? They are betting big on AI, right? They see a gap in profitability and valuation, which is, yes, I agree with them. Now, when I think about 2024, like this question always come to my mind: what will happen in 2024? Where should I bet? Right. So at least this is what they are saying. So US stocks typically post their best returns in the final quarter of the year, which is kind of Q4 is almost here. Uh, because much of the market's return this year has been driven by a handful of mega cap stocks. You talk about Nvidia, you talk about few other stocks here. In tech plus sectors, we believe there is opportunity to uncover those next level stocks that have yet to be fully rewarded for their fundamentals. So literally what they're saying is that, you know, if you know we this is what they're saying: we see smaller reward in making bold calls on big picture, and much greater potential from making good calls on individual stocks. So definitely they are going to be winners. They are going to be winners from this time. I can't tell you which stocks will be winners. Like you go in future, like in 2024 from now, there will be some stocks, some companies which are going to, make you a lot of money. Right now it's a great time to look into those opportunities, to find those opportunities, to stay patience, to keep patience, and kind of it will get rewarded. At least that's what I believe. We'll see about that. So I pull outliers dashboard here, and what do I see? Pretty much all the sector and indexes are in that downtrend right now. You see this red arrow here, and I also see a downside indicator. It's in orange, which means there may be some problems, ongoing problems going with these sectors right here: financial, discretionary, technology, all of these sectors. Um, but if I think about it, if I go back to my previous point of this shorter cycle, yes, you are going to see these shorter cycles. You go into S&P 500, right? So we saw that we literally exited somewhere around this time frame. That it keeps on falling. We may see a recovery point, this shorter cycle that I was talking about, and an opportunity may present around that time, right? It may happen in few weeks, few days, I don't know when, but I'll keep an eye on how it is. And then, if someone want to benefit from it, they can go and take a look at this data right here. And same story with other sectors. Your Dow, right now I think there is a lot of investor fear that is building up, and we may see some good opportunities again for the shorter time frame until Fed start uh, decreasing the rates. So until that happens, You may not see something, okay, you buy today and just it's keep on going up. Now, the shorter cycle, you have to remember that you have to, stick with it. You have to prepare yourself, for more active investing if you want to do that. So same story I see pretty much all across the sectors, your technology sectors and other sectors. I won't touch it right now if I'm a long only, and I'll stay, outside, in cash. And when right time comes, I may benefit from these shorter cycles if I decided to do so. So thank you for watching, and I will see you next week.